Welcome back to Morning Trade Live. Time to go inside out on Lennar ahead of its earnings that are due out today after the closing bell. Jay McCanless is with us, Managing Director, Equity Research at Wedbush Securities. Thank you so much for being with us. As I look at a name like Lennar, all of these home builders have had things to deal with. I mean, they don't know with inflation and tariffs, a higher mortgage rate environment, what kind of consumer demand will we see? What are you expecting to hear from Lennar today?
Well, thanks for having me on, Nicole. So in terms of the EPS, we're looking for $2 even. That's a little ahead of the street at $1.96. But I think the key number we're going to be watching is their home building gross margin. We're expecting 18%. The street's at 18.6. So any number south of either our number or the street number, I think may reflect negatively on Lennar and the rest of the group. The mortgage rate buy downs that Lennar and some of the other entry level and payment focused builders have been using are pretty expensive from a gross margin perspective. And with rates really not giving up the ghost this year, those buy downs have gotten more expensive for the builders to pay for.
One of the reasons why those new home sales were doing better than existing home sales. They were able to offer buy downs, give folks a little break on the higher mortgage rates, because the people who are in the existing homes certainly aren't giving up their mortgage at 3% or so, for 7%. So at this point now, when you think about Lennar, is it in a group of its own, or are all the home builders going to face some of the same issues? I mean, we're going to hear from Lennar today after the bell. Is Lennar similar or different to the others? How so?
Yeah. So if you think about Lennar, group them in with other names that we cover, like a D.R. Horton or an LGI Homes. Those are builders that are more focused on entry level, payment sensitive buyers. And I think any bad news we hear out of Lennar might be a negative read through for Horton or LGI. But at the same time, one of our better relative performance calls this year is we focus investor attention on the move up names, like a Pulte where we're outperform rated, or Taylor Morrison where we're also outperform rated. Those names have performed a little bit better than the ITB and a little better than the group overall. We still think that move up buyer who isn't completely rate insensitive, but is bringing some equity from the sale of their current home. That buyer still seems to be showing up and buying homes. So those are the names we'd focus on. But if there's any bad news out of Lennar, I think it is going to be negative for Horton and LGI, and we're neutral rated on both those names.
So for Pulte and Taylor, those are more of the upscale or luxury, and they're going to be less affected by some of the recent volatility. That's really interesting. And you do have buy ratings on both of those names, Taylor and Pulte. What's your rating on Lennar right now and your price target?
We're neutral rated on Lennar.
Neutral. And right now it's at 109. Where do you have fair value?
130 is our price target on Lennar.
Oh.
So some upside there, but as I talked about at the beginning, we're very concerned about gross margins right now. Gross margins for especially these payment-focused builders have been under a lot of pressure this year, and with mortgage rates basically hanging around 7% for the past few weeks. We're just concerned that there may be some more downside risk to gross margins than what the street's expecting at this point.
Has the deportations, less immigration story come to fruition? There was a lot of talk about fewer folks coming over into the United States. There's deportations that are happening. Are we actually, in fact, seeing a significant change in how homes are being built because of the labor story, or fewer laborers?
Not yet. I'm sure that's going to be a question for Lennar's call tomorrow. The conference calls that we had during April and early May, at that point, the builders were not seeing any effects in the field. And if anything, I think this slowdown in multifamily construction has freed up some more people to do framing, roofing, et cetera. So the builders, by and large, a month and a half ago, were reporting that labor availability was actually improving, not getting worse as some people expected. Now, I do think that question is going to be a key one for the builders, for Lennar tomorrow, and then for the rest of the names as they report next month. I think any impact from deportation is something we're going to have to factor into our view on the group. But so far, we haven't seen a real impact from it.
It's not like tariffs. You know, tariffs is still being worked on, massaged, negotiated. The immigration story sort of has happened, right? The borders were tighter, fewer people coming over. The deportations have been underway, you know, maybe more so lately, but they've been underway. So do you really expect the picture to change in the next 3 months? I mean, isn't this it? Aren't we here?
You're probably right, Nicole. The other thing I would say, especially for these entry-level builders, is that they have, we think, a pretty healthy inventory of unsold homes that they need to sell through first before they reaccelerate housing starts. So if there is a temporary blip down in labor, this actually is not a bad time for the builders to slow down their starts pace. So yeah, I think you're right. I think the impacts we're going to see over the next 3 or 4 months are probably how it's going to be for the next couple of years. But again, you know, we've heard relatively quiet news, I'd say, from most of the builders, but I do think it's a timely question. It's something that's going to be a focus of the upcoming conference calls.
All right. Jay McCanless, great to speak with you at Wedbush Securities, where you do have the 2 buy ratings on Pulte and Taylor. Thank you so much. Good to see you.
Thanks.
Now we're going to trade this name. We have an example trade for you on Lennar and more. Tom White is with us. So let's start with that. Tom, good morning.
Morning, Nicole. Yeah, the option market, implied volatility levels elevated. Option market pricing in about a plus or minus $7.50 move, so about 7% move. In the shares either way. Stock is down over 43% from those all-time highs that we saw last September. So the bar's really low going into this report. You see the one-year chart there. It's been a spectacular decline here for a lot of these home builders, but with the 30-year mortgage rate near 7%, there's more houses coming online. I think we're up 14% year over year as the number of listings continues to grow. But that being said, this whole sector has been under pressure, probably based on the fact that home prices are still elevated near record levels and you've got high interest rates at this point. So I looked at a strategy that takes advantage. If you think this thing's going to rebound post earnings because the bar is low, this strategy takes advantage of it. I'm looking at a bullish call diagonal, really short-term positioning, going out to the June 27th weekly cycle. So giving myself 11 days. We're going to buy the at-the-money 109 strike call there. And then against it, you want to take advantage of that, what the option market's priced in, that 1 standard deviation. We're going to go out to the June 20th weekly cycle or monthly cycle that expires in just 4 days. Sell the 116 strike call. So a bullish $7 wide call diagonal to the upside. You're paying roughly about a 320 debit. So you're paying less than half the width of this call diagonal. And the reason that it's costing less for a $7 wide call diagonal is because that vol dispersion we always talk about. You're buying basically in that June 27th weekly cycle, you're buying about a 57% implied volatility on aggregate. In the near-term options in that June 20th on the 116 call that you're selling about an 84% implied volatility on aggregate in that option series. So that lowers the input cost. You want the stock to go up at or near that 116 strike, but anything above about 111, 112 is going to be profitability on this type of bullish call diagonal.
All right. Thank you for that. And then we'll also just bring in the Toll Brothers story, too. Some of your thoughts on Toll Brothers at this point. What would be an example trade there? It's at 108 today.
Yeah, this is the high end of the home builders, right? Average selling price of near $1 million each. Is that more affluent consumer still buying? Well, this stock's still off about 37% from its all-time highs that we saw in November, so it's pulled back pretty significantly also. So I looked at something a little bit more conservative on this one, even with that pullback. If you want to own the shares, maybe you want to create some yield against that long stock position if you think the stock's going to at least consolidate, if not go a little bit higher. So I looked at a covered call strategy where for every 100 shares of stock you buy in Toll Brothers, we're going to sell an out-of-the-money call. I went out to the July 3rd weekly options that expire in 17 days and sold the 112 strike call against your long stock. You're paying roughly about $106 is your debit on this one. So you got $10,600 in risk. That's if the stock were to go to zero. But your break even is 106. So you're buying the shares at a discount because you sold the upside call against your long stock position. And then it's got about a 0.9% dividend yield. So you're going to collect some yield by owning the shares in the way of dividends also. So this strategy is conservative. But at the same time, if you want to own the shares, you buy them at a discount. And then as you get closer to expiration over the next 2.5 weeks, you'll have that ability to roll or adjust that short call, creating more credits. That's going to lower your break even and increase potential profitability on a trade like this.
Okay, Tom White, it's great to see you, and thank you for those. And we'll
Thanks.
watch for Lennar today after the closing bell. Thank you for those example trades, Lennar and Toll Brothers.